Hello friends and welcome to my YouTube channel Simply Stocks, and today I am going to talk about a very interesting concept coined by William O'Neill, and this is called the Canslim approach to investing. So let's get started. First of all, a disclaimer that this is not a stock recommendation, and people taking any position into any share that I talk about should do that with their own due diligence and research, and I'm not in favor or against any company that I talk about. So now we talk about the Canslim approach. A little bit about the market. It has already gone to 11,600 is 700. The Nifty, I believe it will go to 11,800 to 12,000 levels at best. And probably if you people are invested at 10,600, 700 levels, you need to book out, because I feel that over the next 6 months, the market would be sharply lower than what it is today. So just keep in mind. So kindly watch my videos in which I have talked about Nifty to be 9,000 in the coming days. Now coming to this concept of Canslim, a little bit of snapshot of what it is all about. It was pioneered by a renowned investor, William O'Neill, and he has this book about how to make money in the stock market in the good times as well as in the bad times. And I have the link of the book in this video as well. You can go ahead and buy that book and read it out. Basically, that book talks about this concept of Canslim, and it is basically a top-down approach of investing, in which you invest in the companies which are producing astonishingly good results. The company is having profitability growth of 40, 50, 100% year on year, and also quarter on a quarterly basis it is growing sharply. And then you invest in that company and ride the tide when the going is good, and the company becomes 3x, 4x, 10x in a very short period of time, over say 2 to 3 years or 4 years. And many people go by this and invest in companies in this manner. I know one of the investor who has written a book as well, who has bought a consumer company in the early 2000s and made millions from it. He follows this approach. I don't want to name at the moment, but that is how many large cap investor or large investors have made their money in the market. So I want to just explain in detail as to what this Canslim approach is and whether it is viable to follow it or not. Uh, so basically, what happens here is you want to invest in companies which are making a huge amount of profits over the last 4 or 5 quarters. So basically, it talks about the Canslim approach has CANSLIM embedded in it. C stands for current quarterly earnings. It should be 25% or higher from the previous year. What it means is, suppose somebody or a company or company X has done 100 crore profit or a net profit, on that is the bottom line, in FY18, say September quarter of FY19, and it does 130 crores in September quarter of FY20, which is this one. Then you would say that it's a 30% growth, and that qualifies for this Canslim approach. The margins should be 17 to 20%. So when we talk about net profit margin, it should be around 20% or so. So 130 crore profit, if you say on a 2600 crore uh, sales, would be of that sort. So that needs to be taken into account. It should be low debt or keep reducing debt. This is extremely important, that a company, when you invest in such a company, that should be having very low debt, because if they are increasing debt, and debt is huge on the books, and yet they are leveraging that to bring in profits, that is of no good, because later on they have to pay back debt, and the interest cost or the interest burden really looms on the company, and eventually the profitability erases itself from the profit and loss account. The trajectory of the profitability should be up. So for instance, a company might be doing 1 crore, 1.5 crore, 1.7 crores, say in 2013, 14, 15, and then straight away they were doing profitability of 3 crores, then 5, then 8, and then 12. So when I say 3 to 5, that is a big jump, but 5 to 8 or 9 is an even bigger jump, and 9 to say 18 or 20, that is more than double. So the trajectory of the profits or the growth of profitability keep increasing many folds, or at least it keeps increasing uh, by around 25-30% year on year and growing fast. So the EPS growth of the company should be 20% or more. Normally, what we look for, or what these people look for in this Canslim section, are those companies which can do 30%, then next year 40%, then next year 80%, and then so on and so forth until it goes to 150-200% profitability growth, and then it stabilizes between 30 to 40%. Those companies really do well over 4 to 5 year period. Coming to A of Canslim, it is the annual earnings. So when we have talked about the quarterly earnings, but even more important would be the annual earnings, because quarterly earnings would take into consideration seasonality, etc. Winters, summers, and the rainy seasons, etc. might be no, favorable, unfavorable for a number of industries. But when you look at annual earnings, the annual earnings should grow at more than 25% year on year, and over the last 4 5 years it should have grown between 25 to 35% year on year. That is what is required. We have to take into consideration the numbers for the last 3 to 5 years. There should be no one-offs or extraordinary when we are talking of companies, when we are selecting. So there could be a couple of years in which they would have got some you can say deals which are one-offs, and they would have got profits out of it, or they or tax rebate in 1 year, and which they would have not got in the other 4 years, and they would have got a lot of profit out of it. We have to take that out of the equation and then rationalize the numbers and find out which are the companies which are growing well. EPS growth which is increasing. So first year they do 20%, then they do 25%, then they do 30%, as I said, year on year. Those companies are best to invest in, even if the stock price keeps moving up. These are best companies to invest in. Cash flows should be robust. So cash on books is extremely important, and for that to happen they need to have very good operating numbers. So the what we look for, or what these people look for, are operating profitability rather than net profits, because net profit take into consideration depreciation, taxes, interest, etc. Operating profitability should be very good. So it should not be just 20%. Operating profitability, in what I understand and understood from the concept, should be between 28 to 35 to 40% growth. Coming to the N of can, and that is one of the key elements of investing in a stock. New could be anything, new product development. So the company keeps coming up with new products, new innovations, or new management style, or etc., new services, so that they remain in the market very well, and they do really well in the market. And these companies always stay at the top and keeps their leadership hold on the industry by producing better quality products year on year or quarter on quarter. They bring in more products, or you can say they bring in more acquisitions. So if the company cannot produce more, what they do is they acquire their competitors, or they acquire other companies which are producing very good products. And these acquisitions also go a long way in bringing in more profitability for the company, and hence more EPS growth. So the company would come up with more acquisitions or buyouts, or in that sense they'll buy in products, or they'll buy in management and the whole company in itself, in order to become more profitable and become more of a market leader and have more market share in the business. What that does is it catapults them into a new league, and their profitability goes rocketing towards say 40-50% growth by acquiring some other company whose profitability is really good at 25-30%. But what you need to look at here is which companies are they acquiring. Those companies should not be having a lot of debt. Those companies should not be into losses or something of that sort, or is continually being managed through being in losses and with equity and etc. and dilution and so on and so forth, those companies should be as robust as the company itself, which is buying out the other company. So that needs to be kept in mind. New would also suggest change in management, so new management comes in. So for example, there could be a company that might not be doing well for the last 8 10 years, and then there's a management change and new management comes in with a new paradigm shift for the company, and it starts doing well. So you need to keep an eye out for those companies in which there is a top level management change that is taking place. Companies which are innovating a lot, building new products, coming up with R&D activities, and experimenting big time are very good investment opportunities. And that's why companies in the segment of chemicals, pharmaceuticals are best suited to invest through this Canslim approach. But there are companies in the consumer domain as well, which you can look for through this approach. So keeping pace with the competition is the main aim. It is not that you sit on your laurels and make money and you'll do that over years. The company keep innovating and keep challenging itself and bringing in better activities or uh, better standard operating procedures in order to bring in more productivity for the firm. That is what is needed. The S in the Canslim would stand for the supply of stocks, and this is extremely important in the sense that there are a number of companies which do well, but because of a lot of liquidity and because of a lot of equity in the market, does not perform well in terms of the stock price. So the stock price do not move a lot, although the company is profitable and doing well and coming out of losses and everything else, and the sales is growing, but yet the stock doesn't move a lot. This is because a lot of people, especially the retail investors, have the shares, and not the stocks are not with those people who are holding the shares for a longer period of time. It's a double-edged sword. Yes, if the company doesn't do well and keeps producing losses or lower growth, then the stock will fall big time because there is less supply in the market. So at suppose you want to sell at 100 rupees, you'll be able to sell at 95 rupees rather than 100 rupees. You'll have a straight away loss of 5 rupees on the stock, and so on and so forth. But more or less, it has been seen that those companies who do well and have lower equity does really well in the market, and these companies double up, triple up very quickly because there is less supply and a greater demand of the stock, and so people can buy the stock at a very high level, even 8 10% higher immediately when the results are really good. So low equity base helps rather than is detrimental for a company. Most of the equity should be with the big players, even if the promoter say holds 35 40% of the stocks. The other 60% should be divided with some of the big wigs, whether these are mutual funds or institutional investors or even individuals who are large, say HNIs, high net worth individuals who invest big time into the market. If they have the stock, then you can be rest assured that they'll not be selling in the market so much, and the general public should be having lesser of the equity. This is something that we need to look at while investing into a firm. uh, the company or the management should be keep buying the stock at lower levels. The promoters should increase stake continuously, or if they have increased a lot and they have a very high holding, this is also good. But if they have say 40 45% or even less holding, and they are increasing it quarter on quarter, this is also very positive for the stock. The L is for leaders. So you need to pick leaders rather than laggards. And by leaders, I mean the top stocks in the industry. So I have the example here of DMart, that it is one of the largest, you can say, departmental stores here in India. And you have the big bazaar and everything else. But why DMart does well is because of uh, its ability to produce profits on the bottom line, and its ability to have a higher amount of sales even on a very big base. So it's a very large cap company. It's not a small or mid cap company, yet is producing robust 25-30%, even in some cases 40-45% growth on the bottom line. And that's why the stock is doing so well at 1900. I'm not saying that you go ahead and buy DMart tomorrow. I believe that it is expensive at the moment at around you would say 80 times, 85 times 2 year forward earnings. But I'm just giving you an example that such company is a market leader, rather than buying some other company which is not profitable but is increasing sales, or some other company which is having a lot of profits but having a lot of debt as well. You go ahead and buy companies which is a market leader, which is selling a lot, which is a big brand in the market, and is also profit giving profits of more than 20-25%. That competition, that combination would really help you make a lot of money in the market. Avoid laggards even if they look attractive on PE. This is extremely important. This Canslim approach helps in people understand or keeps the bias out of PE, price to earning, and we all go by price to earning. Oh, DMart is quoting at 120 times. Why should we buy? Even if it comes down to a PE of 70-80. At a PE of 80, it looks expensive. Why should we buy? Similar with HUL, similar with Asian Paints or Page Industries, etc. The point is these companies keep producing 30-35% profit growth even in difficult environment, and that's why they have such a high PE. I'm not saying that these are the companies you go ahead and buy tomorrow because these are doing really well in the market at the moment. But my point is you need to find out other companies of similar stature, and this is how most of the large investors have done. This one concept of Canslim can help you navigate through the 5000 stocks to find out the best in them. So the I in the Canslim is about institutional holding, and you can understand this, that if no institutional or large investor or an individual is buying stakes, a 7, 8, 5, 10% stake into the company, then the stock is never going to go up. If all retail investors are into it and want to really buy the stock, even if the company is doing well, for the stock to go up, large cap HNI, institutionals, FII, DIIs need to buy out, or the company itself need to buy a lot of shares in order for the stock to go up. So institutional holding need to be big, and it need not to be very big, but still someone should be buying. So FII holding of even 2-3% is good enough, because in this approach, many of the stocks which become 20x 30x are small cap stocks. So in that there's not a lot of institutional holding, but even 3 to 4%, then 3-4% of individual holding by people who are big investors with their own investment firms, PMS accounts having 2-3%. So in all, around 8 to 10% holding with these kind of people help you understand that okay, big people are buying it and they are holding this company. So they are buying it after meeting the management. So you have to take that into consideration. So large institutional holding or large institutional investors should be holding the company, should be holding stocks of the company, whether it's be only 2-3%, even that would be good enough. And management stake should be high. Now in that regard, I would say that in some cases it could be that the management stake is 30%, as I said, but large cap investors, FIIs, DIIs have around 20-30% of holding. So that's 60% of the stocks that would not come into the market, or the supply would not be that much. Only 40% are with the general public, and even there could be some individuals which would be having 2-3% stake. So you need to dive into shareholding patterns on different sites to find out the company's real shareholding pattern. Don't go by one website, and then you'll be able to understand as to what exactly is the shareholding pattern and how many shares are with the general public who trade the share. And then you'll come up with whether it is good enough for investment or not, based on the institutional holding framework. And the last part is the market direction, or M in Canslim, and this is also important. This is where the final aspect of investment comes in. That you have understood everything and you have analyzed a company, say a company A, which have very good institutional holding. The company buyback shares into it. They have a 20-25% profit growth, even greater than that, year on year, quarter on quarter. They are growing well, and the company have very good high margins, etc., and so on so forth. But if the market direction is wrong, for example, at the moment IT's sector is not doing well. In the last couple of days it has not done well, and it's the consumption which is doing well. So if you want to buy into consumption, you have to wait for declines, and this is where market direction helps. If the market direction is not favorable, then even if you buy at the moment, it won't go up that much, and you won't have that percentage gains immediately. So you need to wait it out, let the correction and the short term correction, and it is very good for people to find out prices to buy at. So do a little bit of technical analysis and buy at the time when the market direction turns towards the stock, and you buy immediate just before it, and you get into profits immediately. This is how it's done. It is extremely difficult, but this is one way in which to analyze as to which price to buy at. So the overall market direction is also required to be analyzed. So if the, say for example, Sensex and Nifty is going down big time because of some reason, even if the stock is good and have very good earnings, that will fall as well or won't go up. So you need to let the storm pass by and buy. This is what the market direction tells in Canslim. So this was my video on the Canslim approach. Please like and subscribe my channel and hit the bell icon so that you can get my videos straight away. Please write in the comment box as to what you think about the video, and if you have any queries. Thanks a lot for watching.